So what we have discussed so far, section 92 is done, which is the charging section, which says there has to be an associate enterprise. The transaction has to be an international transaction or specified domestic transaction, and such transaction should have been done at arm's length price, or if not done at arm's length price, then income tax department will recompute the transaction at arm's length price, and then there will be addition to the profit margin. So far we have discussed what is associate enterprise and international transaction. In this lecture we are going to discuss what do you mean by specified domestic transaction. So why specified domestic transaction provision has come into play? So you know that there are entities which claim ATIA benefit. ATIA benefit gives 100% deduction for the entity. So if this is the eligible unit is having sales of 500 crore and cost of 300 crore. So please understand the profit is 200 crore. Sir, are they going to pay tax on this 200 crore? No, because they are eligible unit. There is another ineligible unit of the same entity. It's not a separate entity, it's a same group entity, and that ineligible unit is having 1000 crore rupees sale and cost is here 400 crore and the profit here is 600 crore. Now you know that on this 600 crore they are liable to pay huge amount of tax. So what this ineligible unit will think now, instead of showing this as a real transaction, let me reduce this. Okay, let me show this transaction at 500 crore. Okay, the sale is 500 crore, then the 600 crore will be reduced to 100 crore, and we will book the purchase here. Here another purchase cost from related party or associate enterprises. Another 500 crore is the cost, and here sales will be 1000 crore. So the 500 crore rupees profit is shifted from ineligible unit to eligible unit, making here 700 crore. Now you will say, sir, what is the point in that? Anyhow my total profit is the same. Yes, total profit for whole group remains same, but my dear friend, this 700 crore is not taxable now. That was the tax evasion done by many domestic companies. Therefore, whenever there is a entity which is having eligible unit and non-eligible unit, and any transaction which has happened between these two entities, it has to happen at arm's length price or fair market value. If you don't do that, then we are going to recalculate the prices and we are going to make an addition. Okay. For the purpose of section 92, 92C, 92D and 92E, in case of assessee, the specified domestic transaction shall mean any of the following transaction not being international transaction. Any transaction namely referred in 80A, that is inter-unit transfer of goods and services by undertaking or unit or enterprise or eligible business or to the other businesses carried on by the assessee and vice versa. Okay, if it is a sale transaction, it can be a purchase transaction for consideration not corresponding to the market value as on the date of transfer. Obviously, you are manipulating your data. Any transfer of goods or services referred to under section 80IA, inter-unit transfer of goods or services between eligible business and other businesses, where consideration is again not at market value. Any business transacted between the assessee carrying eligible business and other business referred under section 80IA subsection 10, 80IA subsection 8, subsection 10, 10AA, all these are profit linked deduction and inter-unit transfers. Any business transaction between 115 BAB. Please understand, this is something new which has been amended here. So what do you mean by 115 BAB? For manufacturing entity, please understand, for manufacturing entity now, whatever profit is derived by the manufacturing entity, we are having a tax rate of 15% plus 10% surcharge plus 4% cess. Okay, meaning thereby somewhere around 17 point some percentage is the tax amount. Obviously, this manufacturing entity is in the lower tax bracket, and because this manufacturing entity is at lower tax bracket, what will you do? You are having 5 more entities which are not newly incorporated manufacturing companies. So you will try to transfer profit of those 5 entities. Please understand, those 5 other entities to this manufacturing entity. You will try to book highest possible profit in manufacturing entity. Though it is taxable at lower than effective rate of these 5 entities. These 5 entities might be taxable at 25% and this entity is taxable at 17%. Obviously, somebody to save taxes will try to shift profit from non-eligible units to 115 BAB units. any other transaction as may be prescribed by the government. However, above mentioned transaction, this is the most important MCQ that you should remember. To active specified domestic transaction provisions or in transfer pricing provisions, there has to be some monetary limit, isn't it? So the transactions will be operated under this if the value of transaction is 20 crore or more. Very, very important. If you remember AMT, alternative minimum tax, there we have limit of 20 lakh. So don't get confused. In AMT the limit is 20 lakh. Here the limit is 20 crore. Here the talk is in crores. Obviously we are talking about transfer pricing. We cannot talk in lakhs. It has to be in crores. However, the above mentioned transaction shall not be treated as specified domestic transaction if aggregate of the transaction entered into by assessee in the previous year does not exceed 20 crore. So this is the threshold limit. One simple illustration, okay. An assessee files ROI as under PGBP. Here the PGBP is 1000 crore from non-eligible business. Normal PGBP 1000 crore from non-eligible, here it is from eligible business. 1000 crore is from eligible business, and from non-eligible business 250 crore. Gross total income is 1250, but you know that because this is the eligible profit, that profit will be allowed as a deduction under 80IA, 80IB, and the net total income will be 250 crore. That means the 1000 crore was completely exempted from the tax. So what assessee will try to do, he will try to shift the profit of a non-eligible business to the eligible business to take undue advantage of section 80IB, profit link deduction. So look at this. Assessee has made sale of 2000 crore to non-eligible business. From eligible business to non-eligible business, the sale transaction has entered. AO himself, by referring to the TPO, determined that arm's length price should have been 1400 crore only. The sale price should not be 2000 crore. No. It should have been 1400 crore, meaning thereby profit of eligible business was inflated by 600 crore. Please understand. 1400 crore, and therefore assessee has overstated the profit by 600 crore. So what we will do now? We will add back this 600 crore to the profit. Okay. So the total income is 250 crore. Add 600 crore. It will become 850 crore. AO shall compute total income as follows. Gross total income 1250, and he will disallow the deduction of 600 crore, will allow only 400 crore. Net total income will be 850 crore. Very simple. Sir, here one more example. From eligible business, the assessee is earning 1000 crore. The deduction is 1000 crore and the total income is nil. What is the important observation here? Here we don't have non-eligible business. Here we only have eligible business. Only one business, eligible business. Okay. Sir, but can it be overstated? Yes, definitely it can be overstated. Assessee has made sale of 2000 crore, okay, to another company. AO himself, by referring to the TPO, transfer pricing officer, determine the arm's length price as 1400 crore, and therefore assessee has overstated profit of 600 crore. For any reason this company has made excessive sale, and they are not afraid of making excessive sale or showing it as excessive sale, because whatever profit they derive, this 1000 crore which they have derived, is not taxable. So the real price is not 2000, the real price is 1400. So real profit will be 400. Please understand. Okay. Only 400 will be allowed as a deduction. Balance 600 crore will become taxable. Thank you.